not saying live yet. There, we're live. There's
the.
So, Lauren, we're going to skip the usual tech bros banter and go straight into the hot topic. This reminds me of my days back when I was a news anchor, and shit would unfold, and you have to go straight to it, even if you don't fully understand it. The difference was then it was rare that I'd go live to air and have the world-class leading experts in the shit that just unfolded in the world, which right now, of course, is the big headline. Silicon Valley Bank, for lack of a better term, has closed. You know a lot about it. And our guest, Nick Freund, knows a lot about it. I'm going to bring him straight in. And why don't you introduce Nick, and then we'll get straight into what the hell's going on and what's Silicon Valley Bank.
Yeah, absolutely. And we're happy to have Nick here today. I've known Nick for a little while, part of the New York startup data scene. Nick has a strong background in finance, operations, CEO of Workstream, has a lot of good takes about what's been going on in the world, in the tech industry, especially in the last couple of months, and what that means going forward. He's a business owner. This is something he has to think about every day as he navigates, startup life in the startup world. So feel free to leave comments. I know there's a lot of things unfolding in the last hour, really, with big news, obviously, Silicon Valley Bank, a lot of VC firms, private equity, startups themselves have or had deposits there. So they would keep their bank accounts there that they used to run their business, in addition to other financial vehicles and financial instruments. Especially the venture debt market is kind of been run by Silicon Valley Bank. They've had a huge presence there the last couple of years. So it's going to be interesting. Happy to get into it. And yeah, Nick, welcome aboard.
Yeah, thanks for having me. And yeah, you're talking to a founder right here who has all of his cash at Silicon Valley Bank. So if there's anything I've been doing over the last 2 days, it's been dealing with this complete shit show, for lack of a better expression.
Well, why don't you kind of give us the live version of what you posted this morning? You did, over on TikTok, people do the day in the life. You on LinkedIn this morning did the day in the life of a founder who's got his money at Silicon Valley Bank. So what's the last 24 hours look like for you?
I mean, it's been crazy. I mean, effectively what has been happening is a bank run, and a bank run is panic. And so I was trying to prevent being part of the lemming behavior, because as Lauren knows, I hate lemming behavior. And so about this time yesterday, I started getting messages on these founder WhatsApp threads that, hey, there's problems at Silicon Valley Bank. We're pulling our cash out. And I didn't really do anything about it for the first 4 or 5 hours because people are panicking, and I'm not the type of person who's going to panic for no reason. Anyways, long story short, I ended up getting panicked emails enough from my investors being, you should be pulling capital out of Silicon Valley Bank. And so I started to dig into it at the end of the day yesterday. And long story short, I spent the entire night last night trying to open up bank accounts. And if you think about it, I have no bank account in another company. So if I'm going to wire money out of Silicon Valley Bank, I got to have a place to send it.
You can send it. I'll hold it.
Oh, yeah. Thank you.
Yeah, we'll both take it.
Yeah, my investors would love me to wire you the millions of dollars we have in Silicon Valley Bank. Anyways, this resulted this morning in this long sorted story of me trying to get bank accounts open. I went into a Chase branch this morning because I was told the fastest way to get a checking account open for your company is to go physically into a Chase branch, which I did.
Yeah.
And so in 45 minutes, I was able to get a bank account open at a Chase branch. And then immediately I ran back to my place and I initiated a wire. And about an hour after I initiated the wire, the FDIC put Silicon Valley Bank into receivership. And now the bank is closed. No more business is being processed today. On Monday, all of the everyone who has deposits will get access to their insured deposits. But we have more than $2 million in the bank there, and the FDIC technically only insures you for the first $250K. So that's what I'll have access to on Monday. And there's almost $200 billion in deposits in Silicon Valley Bank right now. So literally right before this show, I was on the phone with my entire team doing an all hands meeting, trying to explain to them the situation and that, yes, we will make payroll. We continue to make payroll. And look, I don't think this is going to be an existential crisis to my company, but yeah, like what a crazy situation for us to have to deal with.
No, absolutely. I mean, my own small potatoes here, I've got, you know, 50K or whatever tied up there. So I'll be hearing from them Monday, I hope, and just get a check written back to me. You know, woe is me. But yeah, it's pretty crazy. Like, what do you like? All yesterday, like I'm in a bunch of WhatsApp threads, Slack channels, Discord channels with all kinds of, you know, people ranging from intelligent to just, you know, lemmings, as you called them, Nick, who, you know, are going to run one way, run one another way, whatever. And there was so much chaos yesterday that it was pretty hard to sort out what was BS and what wasn't. Like, you know, as a founder and someone who, you know, employs people and has money tied up there, like, what was the, like, the, maybe not the play-by-play, but like at what point, like what was the triggering moment when you're like, you know, the oh shit moment when you're like, this is real now, and like, what do we have to do?
Well, I mean, I was talking to one of my investors, and the perfect way to describe a bank run is like the prisoner's dilemma, right? If everyone cooperates and doesn't talk to the police, everyone's going to be fine. No one's going to go to jail. But as soon as people start defecting from the group and talk to the police, then everyone's in trouble. And the worst scenario is to be the person who's the last person, right? Because then you get locked up in prison for the rest of your life. So I was cooperating with the rest of the group throughout the day, and I'm like starting to see more and more people defect and freak out and panic. And I'm like, oh God, like this is kind of crazy. So anyways, I start gut checking, like, should I actually defect? And to me, the crossover moment is one of my angel investors is one of, you know, I won't mention who this person is, but very, very successful hedge fund person, one of the world's leading experts on bankruptcy in general. This is like what this person's career was about. And so I text this person and I'm like, what should I do? And he says, get it out immediately. Get your money out immediately. So when I saw that, I thought he was going to say, don't worry about it. As soon as I saw that, I was like, oh my God, this is, I guess I need to get ahead of this thing. So that for me was the tipping point. And then after that, you could just see it starting to spiral more and more out of control. And so the question was just like, when are they going to run out of capital? And when is this thing going to go under, or this is going to happen? Crazy.
Yeah, absolutely. Crazy. Interesting. Some of our comments are saying they're seeing nothing on the screen.
I'm
I guess they
checking
can
out.
hear us.
I'm checking in to see if people can hear at least. I'm not sure what's going on. Hopefully people can hear. If you don't see the screen, you're just missing Nick's glum face. And by the way, Nick, thanks for coming on right now, because I did write to you right before the show saying you've got stuff to deal with, you know, and totally fine. If you do not want to prioritize telling your story to the Tech Bro Show audience, that in true Tech Bro spirit, you showed up. So let's step back for a sec. How did we get here? Like, what's the, you know, this is either for Lauren or Nick, like what's the Silicon Valley Bank story a little bit? Like, you know, did Lauren, you're able to call out a lot of this stuff before it happens. Is this something that you know, seen happening? Well,
you know, like my partner, my significant other, she works in, you know, consulting and has consulting relationships, you know, with many, like, you know, banks, and in that, you know, community of consultants and various software vendors who I know personally, just like know socially, a little bit businessy, in New York, here where I live. About a month or two ago, a lot of them were saying like, oh yeah, this SVB thing got held up. You know, I'll go out with drinks with people and, like, you know, chew the fat and whatever, shoot the shit or whatever. And people, you know, were, oh yeah, Silicon Valley Bank. Oh man, those guys, like, you know, I guess our thing's getting held up there. And so I've been hearing this for a little while, and I heard it from like independent people. Like, you know, when companies stop, like, you know, Twitter's a good example for people who, you know, might need to contextualize this in the audience. Like, Twitter stopped paying vendors. They've stopped paying like real estate. They've stopped paying stuff. when companies just stop paying stuff and multiple like people know about it, like it usually signals a problem. And so like I you know, I've kind of known, like I didn't know Silicon Valley's positions that they had, you know, in treasuries and in mortgage-backed securities, which, you know, I think we should have learned 15 years ago. Like I wasn't paying any attention to that, but like obviously like a lot of their deposits come from, you know, the money that flows into venture capital and that flows into venture capital funded companies. So it would make sense that like their deposits coming in, you know, which is the money that they have like to play with, like despite whatever levered positions they take, you know, would be at least decelerated over the last year or two.
They've actually gone. I mean, they actually had net withdrawals year over year. Lauren,
Yeah.
sorry to cut in, but if you look
Yeah.
at the beginning of last year, they've lost $25 billion in deposits because if you think about it, to Lauren's point, what's happened is venture capital funding has slowed down. So there are fewer companies who are raising, and all of those companies are burning cash, right? And so what normally would have been and what has been this net influx of capital funds to go invest or pay out other depositors has actually shrunk. Anyways, Lauren, you can keep going on, but that's one of the problems here for sure.
Yeah.
We have James Eichelberger who chimed in, I think, because some people are having video or audio issues.
Yeah, it seems that people on
Finance
YouTube or
yeah.
YouTube people are able to see the show, but LinkedIn might be on a little bit of a lag. So
Okay.
if you're on LinkedIn watching, go to YouTube and it's live there.
Yeah, James is wondering if maybe we were sponsored or financed by SVB, and no, we're not. But
yeah, we're not SVB backed. I'll see if I get my money out.
I mean, my lights have not turned off yet.
Right.
I have internet.
Right.
Today.
Well, right. Well, here's the other thing. Like, I heard a couple of different founders I know personally, just like as friends or, you know, loose business acquaintances or, you know, people I've written a small check for or something. Some of them, like, were talking about Mercury yesterday. I'm going to put my money in Mercury. And Mercury is another, like, as far as I know, like, markets itself as, like, the startup bank, like, you know, similar to the way SVB does possibly. I told all of them, and I don't have any skin in the game, whatever, about, like, you know, what bank they use other than, you know, not wanting them to fail. I said, go to JP Morgan Chase, go to Bank of America. Why are you going to go to Mercury? That's like, you know, having your money in the Italian mafia, and the Italian mafia goes under, and then you want to put your money in the Irish mafia or something or whatever. Like, get it into Chase, get it into Bank of America. And so I was telling, like, my friends yesterday the same, you know, type of thing. It's all very dramatic. A lot of people, are kind of realizing how brittle the whole system is, and you know, I was looking on CNN right before this show, and there's, you know, an article, like, Silicon Valley, I believe, was the 16th largest bank. I heard the number 16. I heard top 25 a bunch, but 16th largest bank. And, you know, obviously everyone's doing this 2008, you know, repeat in their heads. Mary and Nick, you're both a little older than I am. I was, you know, in high school at the time, actually, when that happened. I believe you were both, you know, working at that point. Like, for like working people, like, what was that like back then, and what is it like now? And is that a fair comparison yet, or am I just being a doomsday sayer here, and even bringing up that comparison?
Nick understands the complex finance side deeper than I do. So in terms of the big picture, how similar it is, I'll let Nick take that. But in terms of the initial reactions, the lack of the sort of lack of understanding of how big these things can or can't be was exactly the same. Like, I was watching Jim Cramer over on CNBC, and he sounded like he was going to cry, you know, because this could be, you know, in the big picture, a blip on the radar, or it could be much bigger. And even, you know, someone like Jim Cramer, who's deep in this stuff, talking about every day, doesn't know. So to me, it feels like that. that moment of uncertainty? Is this a
Yeah, I mean, Mary, you have a better sense for people's like knee-jerk reaction to this stuff than I do. I mean, I personally think Jim Cramer's a total jackass. Like his job is to create like panic and to make things bigger than they're supposed to be. He's like a talking head. I mean, we're 3 talking heads right now, but he's like a talking head on whatever freaking channel he's on. To me, this is completely different than the financial crisis. Now, of course, I want to believe that because my money is now tied up in Silicon Valley Bank, and but that was like a systemic problem, right? I mean, you had mortgage-backed security problems across the entire industry. The holes were like trillions of dollars, and the Fed was stepping in. Not just the Fed, but like the banks in Europe and globally were stepping in to back everything. And so there were some banks that went under. But this is, to me, at least from what I understand today, this is much more of an idiosyncratic thing that is related to Silicon Valley Bank, that is related to both, one, the dynamics Lauren was talking about, their exposure to tech, right? And the fact that, hey, actually, like their deposits have shrunk, coupled with what it sounds like kind of non-intelligent decisions they made around how they invested in, right? And if you think about a bank, their source of capital, as Lauren was mentioning, is effectively one of them is deposits, and then their use of capital is to like make investments, to loan money out to other startups, or to invest in like to bonds or mortgage-backed securities, whatever. They were investing in all of these really long-term investment vehicles, which is a really bad strategy when people can draw capital at any point in time. And so what's happened is, what's basically happened is those long-term securities, they went down in value because interest rates have gone up really, really fast. And so holding really long-term, effectively bonds, they become less valuable because new bonds are being issued at much higher rates. And so people want the new bonds, not the old bonds. So long story short, that is happening at the same time that you're losing depositors, sources of capital, and people hear about this and they panic and they start pulling money out of the bank. So to me, this seems like a SVB thing. I think the question is like, are there other weird exposures like that more broadly? And I think the answer is there are, but is that going to cause like this ripple effect throughout the global economy? And I'm not sure it's going to. The reason being, if you don't have to sell those investments to like cover your deposits, there's no reason for that to cause this like really, really bad death spiral, which is what's happening with Silicon Valley Bank, or at least it sounded like, before the federal government stepped in about an hour ago.
Yep. I agree. Like we saw what was it called? Silvergate. Like they collapsed this week. They were, tied up in crypto.
That was the crypto issue, right?
Yeah, that's all just like the same like crypto nonsense. Here's the other thing here, like, forget deposits for a minute. Like, what I think is the more interesting story to all of this. I mean, like short term, everyone's got to get their money out, or they did or they didn't, and like deposits, are going to be covered, hopefully. I mean, it seems like they should be. But Silicon Valley is the biggest. The Silicon Valley Bank is the biggest, for Silicon Valley and tech startups and, biotech and life sciences and all the stuff that venture investing goes into. They do a ton of venture debt, and they do venture debt at like good favorable rates. Founders might not say so necessarily. They might say that any debt is getting shaken down, but they're giving debt out at rates that are, probably better than if you went over to Goldman or, JP Morgan or one of the banks here on the East Coast in New York. What is the venture debt market going to look like going forward? And my piece here on this is that like with venture debt, like kind of up in the air now, that like a big player there has been taken out. I see like a lot of companies potentially, like, they've got a bunch of employees, they got a bunch of expenses. They're going to have to start cutting because that backstop of venture debt that sits there, like, if you can't raise, you need to tap the debt, you need to get into it to keep the company afloat. Like, it feels like, burn rates just kind of got moved forward a little bit. I'm curious, Nick, if what you might think about that, or if anyone has, in the audience has thoughts there, feel free to leave a comment as well.
Yeah, I mean, I don't know what percentage of the venture debt market SVB was, but it was probably, I mean, I think it's the majority of it.
I think it's the majority, yeah.
Or all of it, right? I mean, like, there is one game in town, and the reason as a startup you bank with Silicon Valley Bank really was because they did stuff like venture debt, and they've really been the only game in town for a long period of time. And so, like, why do I have accounts at SVB is because they also have I also have a line of credit that I could draw if I needed to.
Right.
And that, like, JP Morgan is flight to safety, right? I mean, they're an amazing bank, right? But they're not going to give you a venture loan.
Right.
That's what Silicon Valley Bank does. So I think there's some other games in town, but there's not really a lot of them.
Right.
And so I don't know what happens to venture debt as an instrument. Generally, like, someone else is going to have to come in and step into that fray. Lauren, I think to your point, folks that were relying upon on your line of credit, this makes an already bad situation worse. But in general, like, your venture loan is supposed, or like your line of credit is supposed to be, like, let's say on average, no more than 20% of like your round, right? So think of that your round as having been your budget. So maybe your inability to draw that means that this is exacerbated by a factor of 20%, which is not nothing, but it's not like 10x, right? So it's probably going to make a bad situation worse, but not an order of magnitude worse, is my gut.
Right. Exactly.
But on the other side of it, like, who the hell gives you a venture loan? I have no idea. I mean, I guess there's all of the, like, the new fintech unicorns in this space that do the receivables lending.
Their money's also in Silicon Valley.
Yeah, I don't know, right? But venture debt is a different instrument than hey, I have a bunch of receivables and you're willing to loan against that. That's much more traditional. But the venture debt, like what we had, we're an early stage company that is beginning to monetize. That's like true on venture debt. So we'll see what happens.
Yeah, I don't know. This is what's most interesting to me, because I think this says, like, there's West Coast finance and there's East Coast finance, and Nick lives in New York, and he's the East Coast guy. He's a West Coast guy originally. East Coast finance, West Coast finance, like that whole venture debt thing doesn't work here. Like, you'd get laughed out of, I don't know, like the big folks here, like, because they don't want to underwrite it, they don't want to take the risk on it. And so it's like, my point here is, I don't know if this creates is this making a void that's going to be filled, or is it a void that was only filled by the one entity that would ever fill it, and how that plays out. So I don't know. I don't know.
Yeah.
It's interesting.
Yeah, I don't know. I mean, I don't think there's anything that's necessarily broken with the venture debt model. I mean, I don't think this was a result of that. I think the reason SVB did venture debt is because they were based in Silicon Valley, and this is kind of what what they did. And it's certainly a risky thing, but when you blend it across their entire portfolio, that's kind of what their underwriting is about, is like, there's some risk here. Some of these companies we loan into are going to go bankrupt, but on average, we're going to make a lot more from the upside of getting warrants, right? Which is effectively their upside, right? You pay them interest rate, and then they get like some like infinitesimal amount of equity upside in your company because they've given you a debt facility. So But yeah, someone's going to have to step into that fray and take advantage of that if they see it as an opportunity.
It's been a wild 24 hours. I think we can say it's, if not unprecedented, unexpected, what's happened. On a practical level, how does this play out for a founder as of Monday? Right? Because the headline or the press release from the FDIC, they've now created the Deposit Insurance National Bank of Santa Clara to protect the insured depositors of Silicon Valley Bank. And as of Monday, you get that FDIC insured $250K. Is that, and then you see what happens with everything else?
Yeah, I mean, they're trying to ensure stability, right? I mean, what you are guaranteed, like legally, is $250K. And in my case, that's not I mean, it's not all of my money, right? But it's enough to make our next payroll. But imagine if you're one of these companies that has raised hundreds of millions, if not billions of dollars. It has all of this capital parked there, and more importantly, has 400 employees. Your payroll is likely millions of dollars. And by the way, when was everyone's payroll supposed to get deducted from Silicon Valley Bank? Today is the day that they deduct payroll. And so all of these people are looking at, the question is, are these folks going to be able to make their payroll next week or not? We'll be able to make our payroll, but I think there's a lot of people who are going to be dealing with this, and $250K is not a lot of liquidity for the industry in general. And so you would.
And that's really good is a theme that we've been talking about a lot here on the Tech Pro Show, which is, being responsible founders, and is it responsible to be, taking all this venture capital money, low interest rates, venture capital boys, and, building these companies that aren't making money, or is it better to do it like Nick with Workstream? You've done it lean, small, slower build without taking as much of a risk. Right. I mean, it's maybe the ones taking the bigger risks who are now going to be out of luck. Is that what we're looking at?
I mean, for me, this specific moment in time is more difficult for you if you're a Silicon Valley Bank customer and you have a really, really high burn rate. Right. Because tactically on Monday, you're going to have access to $250K per checking account. And that's what you have access to. So if you don't have sources of capital elsewhere, you're going to be scrambling. And so how are you going to figure that out? I think that's difficult. I think in general, the impact to every startup that's a Silicon Valley Bank startup is going to be the same, which is you would think that the FDIC isn't just stepping in to give people $250K of their capital. It's to ensure that depositors are made whole, right? And that's what happened in the financial crisis. So the question is how does that happen and how does that play out? But I think it feeds into some of what you've talked about on the show, just with regards to the riskiness of being a high burn, kind of high growth type of startup, right? These things happen, and all of a sudden, the tide rolls out, and you realize you're wearing no shorts.
Yeah, we have a viewer here who wants to know what would you consider a high burn rate? The
burn rate is really relative to how much money you're making, right? If you're making $100 million, burning whatever, right? I mean, generally, what people would say the traditional mantra for a long period of time was you should have 18 months of runway at any point in time. Is what like a high growth startup would be. And part of the challenges with startups and like thinking through it is that normally you burn capital up front to make capital later. And there's nothing wrong with that as long as that ratio holds, right? I mean, you build product up front, you spend money to acquire companies up front, and then those companies become valuable to you over like the lifetime of the business. And so but that's shrunk a lot. Like now, all of the lemming VCs will tell you that like you need three years of runway. So they just they all decided to change their tune at the exact moment in time after having told all of their companies that, it was only 18 months. And now you need to change that dynamic. So anyways, to directly answer the question, it's really all relative to how big you are and how much capital you have. But for me, I personally am paranoid. I want to have 2 years of runway at any given point in time. That's what makes me generally feel comfortable as a founder.
Yeah. And let's pivot this into some like when we booked you like earlier in the week, and we were going to talk about a couple things about which we can get into now, like some things that you've written and talked about that I've also talked about and others as well. One interesting point here, like you had a good post I don't know, a week or so ago about all the venture industry and how many people are working in it, and how many people are working in it like per fund and per money in the fund, and like some risk assessment in there as well. Like I think the number you gave was, you said that in the next 2 years, like 50% of VCs, by which I mean like headcount, and by that I mean like people working at VC firms, either as partners or principals or analysts or whatever title you want to give someone working on the funds there, like 50% of it would probably go away. Like I'd love to like dig into that and like hear more about your thoughts about what you see in the next year, 2 years out. We know some of the vintages recently are probably not going to perform well. We know Founders Fund, for example, last week they slashed half of their like flagship fund. They're going to move it forward into some different fund in the future. So yeah, I would love to hear about like what your thoughts are there around how this all plays out in the next year, 18 months, 2 years.
Yeah, of course. I mean, to an extent, VCs have been pontificating for however long about how startups need to reduce their headcount. And so this was just my way of giving back some of my posting, to be frank. But if we're just doing the math and you look at it year over year, I don't have the numbers in front of me, but growth stage, not seed stage, because actually seed stage investing, meaning like pre-seed and seed rounds, has that stayed pretty much steady. But anything after that has like completely fallen off a cliff. It's like down 90%, something like that. And just like you could argue that a startup needs fewer salespeople when there are fewer deals to do because growth has shrunk, right? Well, why do you have investment professionals in your fund, right? You have them to do deals. So if you have all these people sitting around and they're not doing deals, we're just going to sit there and employ them forever? I mean, you got to pay those people, right? If you're the manager director of a fund, you're looking at this and like, I have all these people who are sitting around and they're not doing deals. Are we going to need to do deals in the future or not? Because if not, my own investors are going to be asking me, well, why are we paying all those people? And to be honest with you, given the capital, the structure of a VC fund, if they're not paying those people and they decide not to give that capital back to their LPs, which the like managing the director or the general partner of a VC fund isn't under any obligation to do, the people who are left get to split the rest of the money. So why would you pay a bunch of people who aren't doing anything for you? So the point is, if deal flow is down 90% and maybe it's going to recover to 50%, can you still hear me?
Yeah, I can hear you.
Cool. I have some weird thing going on. If it's only going to recover to 50%, you need those 50% of people. And if the answer is no, well, then the argument is, well, 50% of those people probably shouldn't have jobs a year from now or a year and a half from now. And so to me, the question is, are we going to go back to the 2021 go-go times or not? And if we're not, which I think is what everyone is saying, you would expect there also to be rifts and headcount reduction in the deployers of capital, not just the users of capital.
Yeah, on this show, we call them pool boys, which are people who, go on Twitter and LinkedIn or whatever and just kind of stir stuff around. All the venture capital pool boys, you're just, stirring and stirring and stirring. But no, I totally agree. I've and my favorite thing is like I've never seen so many scout funds out there now as well, which I think is very interesting. And I know there's a bunch of scout funds out there, and get the money out, throw the money out, get it out in places. Some of these scout funds that I've seen out there have I don't even know what they're investing in. Someone's just like going out and getting their buddies. It got really dumb, I think, around Web3 and crypto stuff a year or two ago. I don't really know what's going to happen with all this. I think that like if we break it down in sectors, like consumer is really bad. Consumer has done very poorly. I think a lot of people know that, and it's going to become more apparent. And what that means for our viewers, like, it often means like, consumer goods, the whole direct to consumer thing that happened in the late 2010s. A lot of that didn't pay off, actually, if you came on later, especially if you did series, A or B or whatever. A lot of those are completely underwater. And, we're
These
talking
are
about 10 years.
The mattress firms, when suddenly they were.
Well, yeah. The mattress companies fall into that category. I don't know, like it's really bad. And I guess to your point, Nick, when we separate like seed investing, like pre-seed and seed, like early stage versus later stage, like there's been so much these crossover funds that have entered in the last couple of years. And for our viewers who might not know what that means, like a lot of investors like Tiger, you might know or have heard of, or Coach You. These are like large institutional investors that invest in public stocks, basically hedge funds who have made venture arms in the last couple of years. And they're not really doing the seed stage all that much. There are a couple examples, sure, but they come in later and they'll do the B or the C, and they'll get that company that has $5 million in revenue, and we'll say this is now worth $2 billion because we say so, and they'll give them $200 million or something. Like how much of this like venture, I don't know, compression, I'll call it, Nick, do you think is mostly concentrated to these types of crossover funds, or is it just kind of all across the board, or how do you think about that?
I think it's a bit across the board, to be honest with you. I mean, and I'll put this out there, despite the fact that I have to raise from these people at some point in the future. I mean, if you just look at tech behavior in general, especially investing behavior, it is very much lemming behavior, right? I mean, and the easiest way to get a deal done is for it to be a hot deal in the first place. You look at Sequoia and FTX, right? Like they put in however much money into FTX with like zero diligence. And so even the best investors get FOMO and they follow the herd, even if they're the herd like leaders most of the time. And I think in general, the reality over the last few years is when deals got hot for the best companies, they led to these really outsized valuations. And that is kind of reflected in everyone's portfolio. And if you look at the vintages, I think from 2020, 2021, you'll probably see that pricing across the board, regardless if you're the Tigers or the traditional VC fund, if you were chasing the top deals. And I'm not a venture investor and I'm not raising a Series B right now, but I just know that prices have come way, way, way down, right? This year and last year, they're way down. And so I think it's a problem across the board. And I think for those companies, I mean, I think of it more from the company's perspective. If you're a company that has gone and raised a really, really buzzy round, it just puts more pressure on you to grow really fast. And if you can't grow into that valuation, you're going to be raising at some type of down round, right? Because multiples have come down. And so it's going to be very difficult to justify those types of premiums this year or probably anytime in the future, because interest rates are never going back down to 0%. It's just not. Go look at the Fed funds rate from the last 20 years. We're probably going to return back towards more normal, but that's not zero.
Right. It's 3% or 4% or something that makes sense. I do think it'll come down next year. I think a lot of people think that. I don't really, think I'm being revolutionary there, but it's not going back down to zero, and it's certainly not free money. And, that certainly speaks to how much less money is going to be put in the riskiest alternative asset class, which is venture versus, private equity and just stock investing directly or through hedge funds or whatever. Maybe if you want to pivot a little bit, like you also had a good thing that Mary had shared with me and shared it around about
the original book, Nick, was a totally different
Carta.
topic. So much is happening, and we'll take a minute to plug Nick's LinkedIn because he's one of those founders who's actually writing like good stuff and not afraid to express his opinion. I'm not afraid to put people off. And it was a post about Carta jacking their prices, which was like 2 weeks ago, which seems like ancient history now because stuff is playing out, but an important topic. So what was that post about? Why were you bitching about Carta? And explain what Carta is too.
Yeah, so if you don't know what Carta is, it's a cap table management software. And if I'm still speaking Swahili to you, every company raises money from people, and those people are your shareholders. And you represent those shareholders in a table, and you call it a cap table, your capitalization table. And it just represents who owns what percentage of your business. But anyways, you for a long time did this in a spreadsheet. And funnily enough, when I started bitching about Carta, which is creating an electronic version of a cap table, people were like, just use Excel. It's much better than using Carta anyway. But anyways, we're a Carta customer as well. So I'm an SVB customer, a Carta customer. Now I've taken it twice in however many weeks. We were reconciling our books for, I think, like a December or January. And I look at it, I'm like, why is our Carta subscription twice as expensive as it was last year? I didn't hear anything about this. So I start to dig into it, and they just went ahead and doubled my price with like no transparency at all. Anyways, long story short, after having dug into it, I finally found this like customer success manager who was willing to help me. And he was like, oh, well, the reason is you raised capital last year and you've now gone into our higher priced like pricing tier. I'm like, well, are you supposed to tell me about this before you just charge my credit card a higher amount? And they were like, oh, well, we did. So anyways, I unpacked it, and you can go look at my LinkedIn post about it. They just sent me a generic message that says, hi, your Carta renewal is coming up. Go into the portal and check it out. It wasn't, hey, your Carta price is going up twice. Why don't you check it out and let us know if there's a problem? Or here's what your new price is. It's, oh, your renewal is. And if you use the word renewal, people just think, oh, my price is going to be the same thing. So we're really being intentionally like transparent about it. And my take on this is like, why would they do that? Well, Carta has all of these small customers. I pay like $5,000 a year for Carta, which is not like cheap for me, but in the grand scheme of things, I'm like a tiny Carta customer, and they've got tons of folks like me. So their bet is that by being opaque, in my mind, they can just jack up the price, and people don't have another place to go. And it's just a way of like increasing their revenue. And it probably plays into a lot of the stuff that we're talking about, with they're one of these really, really large companies that has a huge valuation. And so they're trying to figure out mechanisms for growth. And so like, oh, well, people have no other place to go. Most people are going to call us out on it. Let's just jack up people's price. So anyways, I called them out on it, and their reaction was, oh, well, we were transparent with price. You didn't take a look at our email. So therefore, we're not going to do anything about it. Here's a month off of your Carta subscription. And I'm like, this is ridiculous. Do I have a problem with you jacking up my price? Though it pisses me off, but like, I'm a software founder. So like, I get it. Like, you need to increase people's prices. But if you're being like a good partner to your customers, be transparent with people. And the worst thing you can do is pull a fast one on them. So to me, it was just really, really terrible behavior. And I was very disappointed in their reaction to it, effectively blaming the customer for something that they were intentionally doing. So I called them out on it on LinkedIn, and it resonated with a lot of people. And people even started suggesting to me other places, including Excel, that I could go to manage my cap table. And so definitely now this is not the highest priority because I have other higher priorities for our business, but it definitely makes you think twice about a vendor that actually held in pretty high regard before that.
Yeah. And I think this is what's so interesting. And, everyone's getting pressure. And you can be a company that sells, like in the calculus of this, you can be like a SaaS vendor that sells a lot of small accounts to many, like small subscriptions to many companies. And, you have 10,000 customers, but they all pay, $199 a month or, whatever, something that's not too significant. You can also be a company that has not a lot of customers at all, but they pay, $200,000 a year to use your software for you to be, a partner of theirs. And, anything in between, any calculus in between where you have a little bit of, big customers, many small customers, et cetera. And, the last couple of years, like the go-to-market motion around those long tail, like many smaller customers has been called like PLG, product-led growth. And this PLG, like product-led growth, the spirit of it is that like the product sells itself, you get sticky with the product, and then you can, upgrade to enterprise plans later. That's all the spirit of it. But, I've seen this get pretty inflated in the last couple of years where these, $5,000 and under software contracts will just double their prices on people, or they'll switch like a payment processor. And I've even seen it. It's a little grimy to even say this, but I've seen it a couple times. Like they switch a payment processor, and like a company will get double billed, and then the onus is on the customer to go back and raise their hand or raise the red flag for the customer or to the vendor and get their money back, because now they're getting charged $199 a month twice because of some little game that the vendor plays. I've seen this pretty rampant. I've seen it a little bit in the e-commerce space with a lot of things that like plug into Shopify or play in the e-commerce ecosystem. And like it gets really bad, in my opinion, around these $99 a month, $199 a month things, $299. Like you're not going to notice it necessarily as a customer. And I think it's pure rent-seeking behavior. I think that every business should be doing like diligence. Like if you got 30 software vendors, 100 software vendors in there, like go in and figure out who they are and what they're charging you, and did that change? Even in running my business, I've seen it too.
It's not ethical behavior, like the basics of business. It's not ethical behavior, like whether it's a $5 monthly bill or a $5,000 annual bill, to double that without like a red line warning and almost like click here to accept is unethical business. I'd like to actually call out a SaaS company that did the opposite. It's one that I'm using as I build up my business. Just a basic content management. It's called Hey Orca. Not the sleekest software, but it did the job, and I kind of picked it fairly quickly because I needed something. And I signed up for what it looked like I needed for my business, which was $180 a month plan. So not cheap for a one-person business. And they saw that I wasn't using all the features, and they refunded me proactively 2/3 of that, which means I am going to stick with them forever. Because like that, honestly,
they put you on the lower plan.
Yes, which was like shocking to me because we're used to the type of behavior that Nick's calling out. So plug there for anyone who wants to use Hey Orca. Like to me, that says a lot. And again, I would, even if I find someone now that's going to charge me $40 a month rather than the $80 a month, I'm probably going to stick with them because I like their business practices. So
yeah, I mean, I think that all of this speaks to a couple of things about, of course, just like ethics or the golden rule or the Warren Buffett, like New York Times rule, like don't do anything that you're not comfortable being on the front page of the New York Times type of thing, which is why I made my post about Carta on LinkedIn. Because I'm like, if you're going to tell me to shove it, well, then I'm going to tell you to do what on publicly. Mm-hmm. But in the end, Mary, to your point about Hey Orca, like now you're on this show or on your show, giving them an advertisement, right?
Yeah.
And in the end, you do business with people, and if you're in it for the long game, you'll be doing business with people for a really, really long time. So there's no such thing as a 1-round game. So you should be playing for rounds 2 and round 3 and round 4. And oftentimes what is the right thing to do in round 1 it really will come to bite you later on. And so I don't think it's more complicated than that.
I think that, and the Cartas and the others were getting away with it. It's because people don't call shit out publicly. Like, everyone was so afraid of stepping on people's toes. And people, like, so many people write to Lauren and I are how can you say stuff publicly? Obviously, she's maybe stronger worded sometimes in how she says things than me, but like, you get respect for it. And people are like, wow, thank you for helping me save money, or thank you for, warning me about XYZ, right? Like, let's get more of that transparency out there. It shouldn't be complicated.
Yeah, right. No, and what you're going to see is, like, there's a lot of grifters out there. There's a lot of behavior that, I call it rent seeking, which is an economic term, like, doubling prices, not telling people, or, random VCs on Twitter trying to tell solutions architects to buy their products and then to put them on webinars for it, and other weird stuff that happens when interest rates are too low. And, that's all going away. And, unless you stand to really make life-changing money and retire off of it or something, you're going to have to play in the game 3 years from now, 5 years from now, whatever. So, it's better to not be a piece of work. It's better to just, tell the truth about things and be someone who's pleasant, someone or a business, an entity, whatever, that's, pleasant to work with. So we do have a question here. We'll get, I want to spend a few minutes at the end just, going over WorkStream and what Nick does. But one final question here from the audience. I'm curious if this, all the stuff with Silicon Valley Bank, I'm curious if this impacts the Fed thinking on raising rates. Will it slow them down on raising rates or not impact?
And that's from Sunny. Sunny at Thought
That's from Sunny. I don't think that actually is going to impact, unless it triggers some kind of larger bank run or, some larger contagion, which I don't think it will in the, larger banking system. I don't think that's going to impact rates myself at all, this single event. I don't know, Nick, what do you think?
Yeah, I don't know if this is, this might sound callous, but I don't know if this is a big enough event in order for it to impact changing interest rates, right? Because the reason they're doing this is try to rein inflation in, right?
Right.
And so to me, the question is this going to impact inflation one way or the other? And it's probably not going to. The financial crisis would have done that, but I don't think this is of that size, at least now, especially with the FDIC coming in to like stem the bleeding really, really quickly here around this single bank. So I think it's probably business as usual with regards to continuing to raise interest rates, unless this changes the trajectory of the economy and or inflation at a macro level, which doesn't seem like it's going to yet, at least.
I'd say to that, tune in next week. Who knows what we're going to be talking about?
But I run a startup. I don't, I'm not an economist, and I don't run a multi-billion-dollar investment shop, so I'm not the expert on that one.
Yeah. Well, Nick, it's been great speaking with you here on this episode and everything. We talked about like the software company you're building, and some of the struggles you've had lately, the day-to-day. Things like that, rolling with the punches and everything. But yeah, would love to hear more about like what you're actually building and like who you're helping and what market you're going for.
Thanks. Yeah, I'm happy to plug WorkStream.io, which is our company. And the high level is teams and companies have sunk, how much money? Lauren, you could talk about this, into your data and analytics technology. There's probably like other episodes where you talk a lot about that, but this is like a huge area of investment. Data is everywhere within businesses today. It really is relevant to everyone within businesses, but there's all of these problems teams experience that result in folks not really using data, right? And companies not really able to properly adopt their analytics technology. And so that's really where we come in, and we help empower teams with knowledge about their data and help them drive adoption of their analytics technology, of their analytics assets, and really support kind of users across their business in their in using data and in adopting data in their day-to-day. And so that's at the high level what we do. We're a SaaS company. We integrate natively with all of the analytics tools that you might already use in your business today. And yeah, if you're a data leader or if you're a business leader and you have these problems, you can reach out to me. I'm just nick@workstream.io, or you can just even go to our website and there's a free trial that you can go ahead and set up, and feel free to go check it out.
Awesome. And also get all the news by following you on LinkedIn, Nicholas Freund with an N before the D.
Yeah, my LinkedIn handle is just Nick-from-Workstream. Nick-from-Workstream.
Fantastic. Can we just end by saying that this all sounds like a Silicon Valley episode? I know we say that every show, but like even the name Silicon Valley Bank.
Yeah, the fact that it's called, I've actually been thinking about the fact that it's called Silicon Valley Bank, and like Silicon Valley is just so risky thing right now. And, it's literally like the name of the Bank of Silicon Valley. It's like calling it like the Bank of the Tulip run up, or, the Bank of Neopets. Well, when Neopets fail and people stop using them, the bank that sits under it all might also fail. So yeah, it's very interesting. And if anyone on LinkedIn who switched over to YouTube, like we'll put the episode up, this afternoon and everything, and have it up. And yeah, thanks for joining, and thanks
we
to Nick.
say hello to everybody today, but we see you there, and thank you for watching. And Tech Pro of the Week is Nick, because you took the time to come out when you're dealing with shit hitting the fan in your own company, and I think that speaks a lot to the transparency with how you run your company, which is amazing. So Nick Freund, Tech Pro of the Week, thank you both, and we'll see you next time.
Thanks for having me. Pleasure.